a very warm welcome to this session today. I am Niranjan Avasthi, Head of Products, Marketing and Digital at Edelweiss Mutual Fund. Along with me today, I have our CIO and in-house expert, the Mr. Bond, Dhawal Dalal, who will be, taking us through our new offering, which is Multi Asset Allocation Fund. Now, let me start with a brief background about this category. So as we speak today, there are roughly around 10 to 11 funds in this category. But the very important thing about this category is each fund is probably very different from each or each other. If you look at this category, there are certain funds which are purely equity. Probably they run more than 65 to 70% into equity, domestic equity, and remaining is invested into gold, silver, and debt. There are some funds which manage very dynamically the allocation between domestic equity. They also invest in international equity, REITs invests, and then commodity and fixed income. Now at Edelweiss, we studied this category in a very, very detailed way and came up with a very different and unique strategy, which we believe will add a lot of value to our clients and will be a very important part of their asset allocation as we speak today. So to talk more about this category, we have Dhawal, and we'll have a question and answer session. We will try to cover as much details about this fund, and post that we will take questions from you all. I urge you all to put your questions, post your questions, before we start the Q&A, so that we can, review them and try to answer as many questions we can. So to start with, Dhawal, my first question, can you tell us broadly about the strategy of Edelweiss Multi Asset Allocation Fund, and also the reason why you chose, why Edelweiss team chose to run this kind of strategies, which is very different from any other multi-asset allocation fund?
So Niranjan, I think there's a very, very important question in my view. As you all know that in the last budget, the indexation benefits which are offered to fixed income funds were withdrawn starting 1st of April, right? So from 1st of April, any further investments in fixed income funds category or any other category where the aggregate equity exposure is less than 35% is going to be taxed at a marginal tax rate of the client. Now, as a result of that, what we are observing is that the net return to clients after tax is going to be dramatically lower than it's now as compared to March before the taxation, new taxation was applicable. So clearly there was a tremendous latent demand for a fund which would probably offer indexation benefit and probably provide steady and slightly superior tax-adjusted returns to clients. So keeping these two factors in mind, what we have done in our NFO of Edelweiss Multi Asset Allocation Fund is that we have structured all our asset classes in such a manner that it will have a fixed income kind of flavor to clients. Our equity exposure of about 35 to 40% is going to be fully hedged, which is going to be run like an arbitrage fund that the clients are very familiar with. Our exposure to gold and silver, 10 to 15%, that will also going to be fully hedged. And the remaining portion of the fixed income fund will be run like a short-term fund, but tilted towards very high quality instruments, all AAA and sovereign. This is going, and the duration of that will be between 2 years to 3 years. So overall, I think this portfolio strategy of the Edelweiss Multi Asset Allocation Fund is designed to provide low volatility, steady return to clients with indexation benefits if remain invested for more than 3 years.
Right. So Dhawal, so broadly, if I could summarize your points, is basically it's a fixed income oriented strategy, and the thought behind the strategy is to give a fixed income kind of alternative to clients with the same old taxation of 20% after indexation after 3 years. That's
That's correct.
broadly the objective. Right.
That's
So
correct.
can you take us through each of these components? You mentioned 35 to 40% arbitrage, then 10 to 15% gold silver arbitrage, which is again very unique, and then fixed income, which is a sizable
Yes.
portion.
Yes.
So starting with fixed income, can you tell us what exactly we'll be doing in fixed income? What kind of papers, duration, why so, and all the details around each of these sub strategies.
Sure. So starting with the fixed income, about 45 to 55% kind of allocation will be in fixed income funds. Now, within the fixed income fund, we intend to keep some portion in government bonds for liquidity purpose, as well as for margin related requirement for equity arbitrage, as well as gold and silver arbitrage. And the remaining portion we intend to invest in AAA rated bonds of public sector undertaking as well as private sector undertaking in such a manner that the duration of the fixed income portfolio is going to be between 2 years and 3 years. So this bucket is quite familiar with investors as the short-term fund category, because as you know, the short-term fund category in the market is about 1.4 trillion rupees worth of total assets. It also operates with modified duration between 1 year and 3 years. So we are just replicating the strategy of the short-term funds in our fixed income strategy with the tilt towards 100% AAA and sovereign portfolio. The idea is that when the rate cycle rates are rising, we will keep the duration on a lower band, and when the rates are falling, we'll keep the duration on the higher band of the 2 to 3 year range. So this is what will provide steady return to clients over a multiple 3 year cycles in our view. On the equity portion, as per the SEBI regulation and the new taxation, we have to maintain minimum 35% exposure to Indian equities to be able to be eligible for indexation benefit. So we are going to keep 35 to 40% allocation to equity, but it will be fully hedged and it will be run like an arbitrage fund. So when you run a fully hedged position, you are agnostic of the direction of the equity market, whether they are going up or they are going down. You will continue to benefit from the arbitrage opportunity. And similarly, in gold and silver, as per the SEBI regulation, we have to maintain minimum 10% allocation to gold and silver. So over there also, we will maintain a fully hedged position. And these two components will provide steady return based on their cycle, right? Of monthly and bi-monthly cycle of the expiry. Whereas on the fixed income side, we will have in the current environment, we'll have a steady accrual of about 7.25% to 7.5%.
Right. So maybe just to add to that, because gold and silver arbitrage is quite new for many people, and probably very few mutual funds do it. And in this category, I think so. This would be first time someone would be doing silver arbitrage, completely hedged commodity exposure. So what exactly is being done here? So as per mutual fund regulation, mutual funds can invest into ETCDs, which are exchange traded commodity derivatives, up to 30%. Now, what this fund would do is buy a near month future contract on MCX of either gold or silver, and sell the next month future contract of the same, whether it is silver or gold. Whatever is the calendar spread will be earned as a return by the fund. So that is one strategy. The other strategy could be mutual funds can hold delivery of these assets in physical form up to 180 days. So the other strategy could be we take delivery of, say, silver, and against that sell a future next month future contract of silver and keep it rolling till the time I can hold the physical delivery, or I hold the physical delivery of silver. And the spread between the spot prices or the physical silver prices and the future prices is the return which the fund would earn. So at any point in time, as Dhawal mentioned, it will be 100% hedge. There won't be any open exposure in either gold or silver. Equity arbitrage is very simple. We all have been investing into equity arbitrage fund. It is buying in cash stock and selling in future. And whatever is the arbitrage is the return earned by the fund. Now, Dhawal, I wanted your inputs on why we are calling this as a fixed income oriented strategy. So while 45 to 50% is fixed income, but how would arbitrage returns or gold and silver arbitrage returns are aligned with interest rates? Will they be very different from where the interest rates are? Would they be closer to interest rates? So, and historically, where they have been?
So generally, the arbitrage rates are generally linked to the repo rate. Yeah, we have observed that most of the time, whatever is the repo rate that is being set by the Reserve Bank of India, the equity arbitrage rates are slightly higher than the repo rate, and they are linked to that. So if repo rate currently is a 6.5%, it's perhaps fair to assume that the returns from the equity arbitrage is going to be slightly higher than the repo rate of 6.5%. If tomorrow repo rate gets reduced, then to that extent there will be a potential downward correction in the equity arbitrage rates going forward. And on top of that, depending on the bullishness in the equity market, the equity arbitrage rates are augmented on a higher side. So for example, right now the equity sentiment is quite bullish. So and the repo rate is around 6.5%. So we are observing that the equity arbitrage opportunities are giving returns somewhere between 7% to 8% on steady state basis. And so this is something that clients can expect in the near term. Similarly, on gold and silver, I'm sure you will show some of the returns, but the silver returns on 3-year rolling basis have a very narrow dispersion. The returns are median returns are about 720 with 7%, whereas the low at around minimum return of 640 and higher return of about 760. This is a 3-year rolling period. So, but on the short-term basis, depending on the demand for silver, in silver being an industrial commodity, as our economy is picking up the steam, and last year our GDP growth was about surprising us on upside at 7.2%, and this year also RBI is expecting Indian GDP to grow at around 6.5%, which will be the highest growth rate in the world. We believe that this should keep the demand for silver and other commodities robust. And from that perspective, we do expect the settlement to settlement rate to be similar to or higher than what the equity arbitrage opportunities are likely to offer. And on the fixed income side, currently we believe that the RBI is going to maintain the repo rate at around 6.5%. Today we had an MPC meeting. And the indication that we got from the MPC is that until the inflation declines durably towards 4%, the RBI is likely to maintain the repo rate around 6.5%. So that means for the rest of the financial year, we should see the repo rate being 6.5%. So this will provide stability of returns on both the equity arbitrage, fixed income, and as well as silver arbitrage. So from that perspective, I think it's going to be a pretty much operating like a fixed income in our view, with very limited downside volatility.
Right. So just summing up, Dhawal, you mean to say equity arbitrage historically we have seen has the returns have moved in tandem with interest rate movement. And I'm just trying to recollect, if you look at the period 2020 till 2021, when interest rates fell very sharply. I remember arbitrage returns were also lower, around 4%, 3.5%, 4% when the repo rate was closer to that level. From that level till date, interest rates have moved to the repo rate is at 6.5%. So, and as we speak today, arbitrage return over the last 3 to 6 months are well above that level. In fact, they are almost 100 to 150 basis points above that. So equity arbitrage is very, very closely, or closely move in tandem with interest rates. To some extent, even silver and gold arbitrage, especially silver, gold has been lower, but especially silver arbitrage also have moved in a narrow range, but well above the interest rate cycle. I remember, one of the two factors play a more important role when it comes to commodity arbitrage. One is demand supply, because there are bouts when there is a wide demand supply gap in a commodity like silver, which is industrial, used in very industrial products. There, when there is a scarcity and the supply is low, the spreads have gone as high as 10 to 11%. And when it is stable, but still the asset class itself is fair bit volatile, the spreads have been around 7 to 8, 9%. But here also we have seen, Dhawal, that broadly they have most of the time remained above interest rates. And that is where, all these three asset class are aligned to each other, and they broadly the return expectation can be closer to a fixed income.
One important point to highlight over here is that while the equity arbitrage moves along with the movement in the repo rate, as we have just highlighted, the silver arbitrage also has a higher correlation with the state of the economy, right? Because it's an industrial commodity. So if the economy is chugging along at a respectable level, then the demand for industrial commodities will also be on a higher side, thereby providing a slightly higher level of arbitrage opportunity. So in our view, assuming the economy is growing faster, and that in turn will increase the demand for silver as a commodity, and thereby providing attractive returns to clients. And at that point of time, if the RBI is raising rates to control the speed of the economy, so that in turn will also improve the returns of the arbitrage, of equity arbitrage, right? And at that point of time, if the rates are being raised, then the fixed income portion will generate slightly lower return because of the mark-to-market losses on account of higher policy rates. So two levers of the funds will generate positive returns, whereas the third, fixed income, will probably generate slightly lower than expected returns. And similarly, when the rate cutting cycle starts, then perhaps the equity arbitrage returns will be slightly lower, whereas the fixed income returns will probably be slightly on a higher side on account of price appreciation. So things will cancel out each other and provide kind of steady return in our view for investors with minimum 3-year investment horizon. So this is the beauty of the strategy. The volatility will offset each other.
Right. Coming to the most important aspect of the funds, and you briefly touched upon it at the start of the call, the taxation. So how will the taxation for this fund, and why also could be one of the questions. We are getting a lot of questions that how much will be equity, and there's some confusion out there. So if you can bring clarity to that aspect, which is taxation, will be great for the listeners.
Sure. So as per the budget of FY24, the government withdrew the indexation benefit from the fixed income funds or any funds where the equity allocation is below 35%, right? So that means all fixed income funds where normally equity exposure is close to zero, they are now being taxed at the marginal tax rate of the investor. And this is something, as a result of that, there has been a tremendous decline in post-tax returns of the client because the funds are now being taxed at a marginal tax rate. On the other hand, the equity funds with equity exposure of more than 65% will continue to enjoy their equity related taxation, that is more than 1 year of holding period will be considered as a long-term capital gain, which is going to be taxed at 10% plus, whereas the less than 1 year holding period will be taxed as a short-term capital gain, which will be taxed at about 15% rate. So the category between 35% minimum equity exposure to 65% is been created which will now be eligible for indexation benefits if the investors remain invested for more minimum period of 3 years, right? So the idea, this Edelweiss multi-asset allocation fund falls in this category, where the equity exposure is going to be minimum 35% but fully hedged. And the other asset classes, particularly gold and silver, is also going to be fully hedged. So from the taxation perspective, investors will be taxed based on indexation benefit, that is 20% tax after adjusting for inflation. And as a result of that, if you go to the table which we have shown in the presentation, Niranjan, the aggregate tax rate for clients who remain invested for at least 3 years is going to be below 10% in our view, assuming the average inflation rate of 5% over the next 3 years. So this, in our view, is probably the most effective way of investing because as compared to other traditional fixed income opportunity, where the clients are going to be taxed between 34% to 39%, in this fund, the aggregate tax rates is between 7% to 9%. And this is significant saving in our view without any dilution in the credit quality of the portfolio or liquidity of the portfolio.
Right. Thanks, Dhawal. Uh, the other important aspect of this strategy is, what should be the investor's expectation, and another important point is who should be looking to invest in such kind of strategy.
See, I will answer the second question first. I think the important portion is the question is that anybody who would like to invest for minimum period of 3 years should consider investing in this one, because the indexation benefits only kick in if the investors remain invested for a minimum period of 3 years, right? If the investment horizon is less than 3 years, then the reason the clients might probably be taxed at the marginal tax rate, which again is pretty high in the current condition for certain class of investors. So that's number one. So investors should come in only if they have investment horizon of minimum period of 3 years. In terms of expectations of return, right now in the current condition of interest rates, while when the repo rate is around 6.5%, and we discussed that the RBI is going to maintain that for at least some more time. In a scenario where the portfolio yield is going to be closer to 7.25 minus expenses and indexation benefit, we believe that investors will probably get around 6% kind of tax adjusted return if they remain invested for a period of 3 years as of today. And I believe that for around 6% kind of return for a person who is in the highest tax bracket is probably equivalent to close to around 9.5% on gross basis, right? So we know that there are no 9.5% kind of rates available in the market for a AAA rated kind of portfolio. So all in all, in our view, investors are likely to get around 1 to 1.5 percentage point more returns per year by investing in this kind of fund for a minimum period of 3 years.
Right. And we have a couple of questions also around this. While we mentioned, what kind of return profile this fund will be and what is this fund a substitute for, what in terms of volatility, what one should expect, and how would be the volatility of this fund versus some, maybe categories like arbitrage fund or equity savings fund for that matter?
In fact, the volatility is going to be far, far lower in our view, given the fact that the arbitrage portion of equity, which is 35%, gets reset on monthly basis, right? So the returns volatility is going to be far lower. Similarly, the commodities arbitrage settlement cycle is 2 months. So over there also, in our view, the reset period coming in every 2 months will probably provide with a limited volatility to clients. For the fixed income remaining portion, as we mentioned that the duration band is going to be between 2 years to 3 years. So assuming that even we are on the highest side of 3-year duration with 50% of allocation, that probably means that on the portfolio level, the duration of the fund is going to be close to 1.5 years, which is on the lower side as compared to some of the other fixed income funds out there. Similarly, in a rising interest rate scenario, when we are able to bring the duration down to close to 2 years, then at the portfolio level, the aggregate duration of the fund is going to be close to 1 year, which is also on a lower side. So on average, the duration band for this fund is going to be between 1 year to 1.5 years, which in our view is pretty much on a lower side and thereby contributing to very little volatility as compared to any other fund class over there. So if you, Niranjan, if you could go back to that slide where we have shown the positioning of the fund, we'll probably be able to demonstrate that the in terms of return and volatility perspective, this is will probably sit somewhere between arbitrage fund and equity savings fund in our view.
Right, Dhawal. I think so. We've broadly covered what we want to cover, and some of the remaining points we'll cover through questions. One of the first question is, if debt is more than 35%, how will we get equity taxation? I think so. Probably there's some misunderstanding. It's not equity taxation. The fund will have taxation of 3 years LTCG period, and after 3 years, long-term capital gains will be taxed at 20% after indexation, which is not equity, but any other capital asset as per the income tax regulation. It is also the old debt mutual fund taxation, which has now been discontinued. This is very important question, Dhawal, and no matter how much we speak about it, returns are the function of type of asset class. So while this fund is very different and it's debt oriented versus some of the other multi-asset funds or equity, it will underperform. So obviously, this category, as Dhawal mentioned, it's very different from the other multi-asset funds. In fact, at the very beginning of this call, I did explain that there are various strategies within multi-asset fund. And even today, forget about Edelweiss multi-asset fund, the funds which are out there, each category, each strategy would have different risk return profile. The strategy which we are running is very different from a strategy where there are open equity position, be it 30, 40% or 65%, more than that. Here, if you see, and the positioning slide is up there, the positioning is between arbitrage fund and equity savings fund. The most important point is there will be no open equity, no open commodity exposure. Both exposures would be hedged, and remaining roughly around 45-50% exposure will be into fixed income. And hence it becomes a strategy which is debt oriented, more like a debt fund. Now, in terms of positioning, why it is maybe slightly above arbitrage in terms of volatility and return, because in arbitrage fund, the fixed income portion is lower. Over here, it will be roughly 50%. So there will be periods where interest rate cycles would move, and as Dhawal was mentioning, there would be some volatility associated with changes in interest rates. While we are still running it as a very short-term kind of category, and over 3-year period, which is the recommended investment period, this volatility recedes down substantially, but there will be slight amount of volatility. And it is below equity savings fund because equity savings funds usually have open equity exposure. So it sits between these two on a risk return matrix, and one should not compare this with a pure equity strategy. And also we would request, if someone would want to take benefit of these asset class from a long-term point of view or capital appreciation point of view, probably this is not the fund for them. This fund is more for debt-oriented investment as a part of your asset allocation, and with minimum investment horizon of 3 years and above. The other question, Dhawal, is on the debt side, and you've got this question many times. Why are we restricting to short term? Why we don't keep it flexible so that when interest rates are falling, you increase your duration on a very higher side, maybe 5 years, 6 years, and take that benefit of capital appreciation. So why we have chose to be in the short term space and not manage this very dynamically?
See, Niranjan, I think the answer to this question is that we want to keep things very, very simple and easy to understand and more predictable for clients. The moment we start managing duration dynamically, then it also adds additional layer of volatility as well as the risk to the client's outlook on what kind of returns to expect. That's number one. Similarly, we have refrained from going down the credit path by keeping ourselves focused pretty much on AAA rated bonds, given the fact that the credit spreads are very, very tight. I think based on our experience of the last couple of months and years, we believe that investors are increasingly getting more comfortable with high quality portfolio. That's number one. Second thing is that they prefer less volatility and more predictability of returns as compared to a non-predictability of actively managed portfolio. So keeping all these two factors in mind, we want to run our fixed income funds in such a manner that the volatility is contained and clients are able to benefit from lesser volatility and higher level of predictability along with significant savings on taxes, and thereby boosting the returns of the client. Because even if I manage, suppose right now we are generating close to 6% post-tax return for clients. By adding duration, maybe you are going to be able to add few basis point more, not significantly alter the outlook of the fund. So for adding few basis point either through credit or through duration, we don't want to dramatically change the volatility matrix of the fund.
Fine, Dhawal. There is one question around, what will be the expense ratio and what will be the, exit load. So the exit load is minimal. It's 0.10% up to 1 month. And after that, there's no exit load. On the expense side, in the regular plan, the expense will be close to 70 basis point, 0.7%. And in the direct plan, it'll be closer to 0.4%. So the expense ratios are also in line with the fixed income strategy, or probably lower than that. In fact, it is also lower than arbitrage funds in the regular plans. Arbitrage fund, the expense is roughly around 1%. Here, the expense ratio is closer to 70 basis point. There's one more question on why the benchmark is Nifty 500, or some portion of the benchmark is Nifty 500 if there is arbitrage in the strategy. So here, our submission is that actually the regulator is working on a new framework of benchmark for multi-asset funds. You would appreciate that, we did mention that there are various strategies within multiple fund, managed by multiple fund in the multi-asset category. And hence SEBI is working on a holistic...
Niranjan, we can't hear you.
Sorry, can you hear me? I can hear you actually.
Okay, in between you got frozen a bit.
Okay, yeah. So SEBI is working on this framework where it will allow each multi-asset fund to have a bespoke, a benchmark within the framework and allow them to have the right set of benchmark. I think so. We are just waiting for that circular. Once it is out, obviously this benchmark will get changed and the new benchmark will be closer to what strategy we are trying to run. There's one question, Dhawal, how the expected returns could be, around, 6.5–7%. Can you just elaborate more on the math? I mean, how much we are expecting from fixed income? Of course, these returns are just indicative and, there's no guarantee, but, if you can just share that math.
So here we are assuming that the equity arbitrage will continue to give 7% kind of return. given that the repo rate is going to be around 6.5% for foreseeable future, at least for the next few months. And the equity markets will continue to remain bullish, given the Indian economy is growing at a pace faster than the rest of the world, and FPI inflows are going to be positive. The silver arbitrage will also give returns slightly higher than 7%, but we have assumed at around 7%. And the remaining 50% of the fixed income portfolio is likely to give a portfolio yield of close to about 730 to 740. So blended yield of the portfolio is going to be close to about 720, and minus expense ratio of assuming on the regular plan is about 7.70 basis point. That probably means that the net portfolio YTM is going to be close to about 6.5%. And as we have mentioned, demonstrated that for clients in a higher tax bracket, assuming that the net tax rate is of about 10%, which is on a higher side, that will take about 65 basis point or so. I think it's going to be close to about 7 to 8%. So assuming 50 basis point to 60 basis point additional return taken away on account of taxes, then we believe that the client's net return is going to be between 590 to 6% after taxes, after indexation benefit. So I think this is something that clients should probably keep in mind in the current interest rate environment. Obviously, this math will change if the interest rate cycle trends lower down the road.
Right, Dhawal. I think so. We have largely covered most questions. And so while we gather more questions, I would just want to, summarize the strategy once again, because some people have joined quite late while we were discussing the strategy. So Edelweiss Multi Asset Allocation strategy is predominantly a fixed income oriented strategy with exposure to equities, fixed income, gold and silver. What is important to note is 100% hedged equity and gold and silver exposure through arbitrage. So there is no open exposure, there's no open long only risk as far as equity and commodity exposure is concerned. Because the equity exposure would be more than 35%, it will attract a taxation of long-term capital gain tax at 20% after indexation, which is probably lower, much lower than a traditional fixed income product today, whether it is bank FD or debt mutual funds or interest from bonds. So essentially, a client with highest tax bracket in a highest tax bracket with 10% surcharge, his taxation moves from probably 34% to 6.5–7%. This fund is positioned as a substitute to fixed income strategy. It sits between, closer to an equity arbitrage fund and quite away from equity savings fund. It sits between these two on a risk return matrix. And most importantly, this is for investors who are looking for a fixed income alternative with minimum 3 years investment horizon. So 3 years and above, because the taxation works in favor only if you are investing more than 3 years.
Yeah.
So,
and if I might add over here that after 1st of April, this is probably one of the few funds available in the market with this kind of indexation benefit for clients. Obviously, those who are looking for equity kind of strategy and exposure, there are many other funds out there to choose from. But if any client is looking for indexation benefit, this is one of the few funds out in the market at this point of time. So this is something to take benefit of.
Right. So Dhawal, lastly, I would just urge you to talk about some of the risks probably which are there in this fund.
Well, in my mind, I think if you are looking for a price risk, what we in terms of movement of the interest rate, obviously the way we want to contain the price risk is by keeping the duration on the lower side. As we have discussed, rather than running a dynamically managed duration strategy, we want to keep a very predictable duration band for the fund, fixed income portion of the fund, wherein when the interest rate cycle is trending higher, we will keep the duration closer to 2 year for the fixed income portion. And when the interest rate cycle is turning, we will keep the duration slightly on a higher side of the 3 year. The reason we want to keep playing between 2 years to 3 years is that in the 3 year segment, as we all observed, that the primary supply is very, very high. And as a result of that, the liquidity in this portion is also relatively better as compared to some of the other segment of the yield curve. And this is something that will definitely provide lesser in terms of liquidity risk is also mitigated. In terms of mitigating the credit risk, we want to focus pretty much only on the AAA rated segment of the portfolio. So the price risk is mitigated by keeping the duration in a tight band. Liquidity risk is mitigated by keeping certain amount of liquidity in form of government securities and certain amount of exposure in AAA rated PSU and private sector. And the credit risk is mitigated by investing pretty much in AAA rated bonds and sovereign paper. So this is how the risk in the fixed income portion is mitigated. In terms of equity and commodities, given this is an arbitrage trades and the arbitrage trades are settled on the exchange, it is pretty much an exchange related risk. So other than the intra-month redemptions, intra-settlement period redemptions that you normally receive, we do not anticipate any kind of credit risk from the equity arbitrage as well as commodity arbitrage, given the fact that they are exchange settled trades, right? And for any kind of intra-settlement redemption risk, we are, as I mentioned, we are going to maintain certain portion of our fixed income in liquid government bonds that we will be able to sell and generate liquidity to pay for the redemption. Having said that, it is important to note that we do not anticipate any unexpected redemptions in the fund, given the fact that most of the investors are expected to stay with us for minimum period of 3 years. So this is also something that we do not expect any unexpected periodic redemptions from the scheme until the 3-year period is over. But that said, we are prepared with certain portion of the fund being maintained in government securities, which will generate redemptions if required. So these are the broad risks that we have highlighted. And if I've missed out anything, you can probably add something.
I think so, Dhawal, you have covered most of the risks. There are a couple of questions around, how the commodity arbitrage would work. While we covered it at the beginning, I think so a lot of people joined later. So for the benefit of them, I'm just re-explaining how the commodity arbitrage would work. And there's also a question, what are the risks into it? Broadly, if you see, commodity arbitrage will be done in either gold or silver. Historically, we have seen silver has better arbitrage opportunities. The spreads are on a higher side. So in silver, there are 2 months contract. Unlike an equity, which is a monthly expiry contract, there are 2 months contract. The expiry is at the end of the month, last working day of the month. So there are 2 ways we will do arbitrage. One is we'll buy a near month contract of silver on MCX and sell the next month contract of the same, which is commodity, which is silver. And the difference between the 2 contracts will be the return which the fund would generate. The other way, the second way, or the second option is also that as per the mutual fund regulations, the fund can take a physical delivery of silver or gold and keep it in the fund up to 180 days. So the other option is when we or have a physical delivery of silver and sell the next month contract of silver, and the spread between the spot price of silver and the future price of silver is the return which the fund would generate. So these are the 2 ways how the arbitrage in commodity would work. While the mandate is wide, there's a question, you have an open mandate to do multiple things in terms of commodities. Broadly, we will stick to gold and silver because the volumes out there are decent enough, liquidity is there, uh, and the idea is to take a benefit from higher spreads in silver, which we have seen over the last decade or so. There are a couple of more questions which are just coming in, and I'll try to wrap them into
Yeah.
one or two more questions, Dhawal. So you also have an open mandate for equity. So will there be any naked exposure in equities if there are good opportunities? The answer is no. Internally, this is how the product is structured, that we will have 100% hedged equity arbitrage or equity exposure will be hedged. Gold and silver again will be hedged, and remaining would be fixed income. So at any given point in time, we don't intend to have any open exposure. Also, will there be any international exposure to bond or equity? No, while the SID will have that leeway, but we don't intend to have any international equity or bond exposure. So there's one question, Dhawal, which you can take up probably. If you are targeting FD investors, the yield would be quite unattractive, as 3-year FD rates are around 7.5 to 8% for senior citizens.
Yes, I believe that senior citizens are better off in investing in fixed deposits of banks, given the fact that their aggregate marginal tax rate is also going to be on a lower side. So yes, I think for senior citizen, perhaps this fund may not be suitable. But what we are targeting right now is the high net worth individuals, those who are in a higher tax bracket. For them, I think this is a very, very attractive investment opportunity, and they also have slightly longer, that is 3-year plus investment horizon. And I think they will probably benefit immensely by looking at this fund.
Thank you, Dhawal, for that honest answer. And we all believe that not each and every product is suitable for everyone out there. There would be a parallel product or a proxy strategy which will be more suitable for a client. So thank you, Dhawal, for that honest answer. I think so we have covered most of the questions, and so Dhawal, we'll just end here. And if you can have your closing comments along with your 1 or 2 line take on today's monetary policy, that will be cherry on the cake.
Yeah, sure. So to summarize, I think we are very excited to offer this unique investment opportunity to clients, particularly at a time where the tax laws have changed and have made the investing in fixed income funds less lucrative as compared to what it was earlier, given that the indexation benefits have been withdrawn. But by structuring our multi-asset allocation funds, we are once again in a position to offer clients with the same indexation benefits that were available prior to 31st of March 2023, and thereby creating a fixed income kind of strategy which invests in equity arbitrage, commodity arbitrage, as well as very high quality AAA rated bonds maturing in 2 to 3 year duration band. We are once again able to provide investors with fixed income related rate returns and with indexation benefits that in my mind will offer close to about 6% kind of post-tax return in the current environment, which in turn is very, very attractive, very lucrative for those investors who are on a slightly on higher tax bracket. And I believe that the addressable market is huge. The current condition and is also pretty lucrative for investors to consider investing in this kind of strategy, and this is something that we want to draw everyone's attention. With regards to the monetary policy, as I've highlighted, and we have just released a note, I'm sure you'll probably get it at some point of time during the day. The Reserve Bank of India has made it very, very clear that up until the inflation gradually grinds towards 4% target, they are not likely to consider any rate cut in the near term. Now that we believe that the average inflation in this financial year is going to be close to 5%, that probably means that the RBI is likely to be on a hold for a longer period, and that in turn will provide accrual kind of returns to the clients in this strategy. Now, as and when the rate cutting cycle will start in the future, then the fixed income portion will also provide price appreciation, and thereby increasing the aggregate total return to clients in this strategy. So it is going to be accrual plus potential price appreciation down the line in this kind of fund. But at that point of time, when the rate cutting cycle will start, at that point of time, your arbitrage returns will also be slightly lower, as they will probably move in line with the underlying repo rate. So in overall, we are very bullish on our state of the economy. I think right now Indian economy is going along on a very solid path. The inflation has also remained lower, is likely to remain lower this year. Commodity prices have been soft. Our food prices are also have come off. So overall, I think we are in a very good position as far as macroeconomic outlook is concerned. And I think to that extent, there are no blind spots that market participants are looking at. So from that perspective, I think one can consider investing for a 3-year kind of time period because that horizon clarity is out there.
Thank you, Dhawal, and I think so we can end our session here. Hopefully we have addressed all your questions around this fund. We have launched this fund like all our previous innovations with some purpose which it will solve in your client's portfolio. Thank you for listening. Thank you for being with us today. And we look forward for your support in this fund, and have a great day. Have a great weekend. Thank you, everyone.
Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.